The first thing we have to do with this question is calculate net sales. And I will go ahead and do that right below the paragraph with the information. So we'll take sales revenue of 1950 minus sales returns of 100 and also sales discounts coming off the sales revenue number of 200. That will give us net sales of 1650. So we'll go ahead and fill that in over here. But I'm going to take a step back here just to look at quarter one. So the ultimate goal of this set of calculation is to calculate the gross margin. Now, we have the net sales number. That was pretty straightforward to calculate for quarter two. But we did not know the COGS. So that's why you have this arrow coming all the way up here. This is your COGS calculation down here using your formula, which we talked about in the last video. Let's start with beginning inventory, add on the purchases that give us a goods available for sale, and we take off ending inventory to get our COGS total for the quarter. Then we can go ahead and bring this number up and calculate net sales minus COGS to determine our gross margin. So we'll have a similar process happening in quarter two. Let's work on that. First step, we're going to say 2,000 beginning inventory plus 1,000 purchases will give us 3,000 as goods available for sale. Recall that this is the maximum we can sell to our customers. Quick calculation here, if we have 3,000 as a maximum, ending inventory count reveals 2,200. Therefore, the difference is what we actually sold. That will be 800. Now, once again, we've done this set of calculation. We can go ahead and bring that number all the way up to fill in the COGS. And then we can do our gross margin calculation, 1650 in net sales, 800 in cost of goods sold. We get a gross margin of 850. So that looks good. We'll go ahead and scroll down and make a few conclusions about what we just did. In order to calculate gross margin, we first need to calculate COGS expense. The large vertical arrow shows how our COGS formula is used to calculate COGS expense, which is subsequently plugged into the gross margin calculation. The ending inventory of the last period is the beginning inventory of the next period. When the bookstore closes down on the last day of quarter one, it expects that the inventory on hand will still be there, barring an extreme event, on the following business day, the start of quarter two. So maybe we'll go back and touch on that a little bit. So you notice that the ending inventory number of 2,000 is the same number up here as beginning inventory. So quarter one ending inventory goes up here as quarter two beginning inventory. So keep that in mind as we proceed. Third conclusion, there's a standard method of calculating COGS expense and gross margin. The calculations are done the same way for periodic and perpetual inventory system. Perpetual we'll look at next. The only difference between the two systems is the method of inventory tracking slash record keeping and the frequency we can perform these calculations. For manufacturing firm, as opposed to a merchandising firm, the items included in the COGS expense calculation may be a little more complex, as covered later. However, the basic calculation concepts illustrated here will also apply. So with that said, let's jump right into the perpetual inventory system. Under the perpetual inventory system, the cost of goods sold expense is not calculated at the end of the period. Instead, the COGS expense is calculated each time a sale is made. The perpetual system exerts more control over the inventory, especially expensive goods like jewelry and automobiles. Perpetual inventory systems are usually implemented through automated information systems. So a modern computerized perpetual system records units purchased, units sold, and the quantity of inventory on hand. Computerized perpetual inventory systems are often integrated with accounts receivable and sales. The computer keeps up-to-date records so managers can access current inventory information at all times. A common feature used in the retail industry is a barcode. The scanning technology quickly and accurately updates inventory information as sales are made. So I'm going to go ahead and make a quick journal entry here, and it should be one that you've seen a few times already in this course. So let's make up a date here. We'll call it May 1st, and the debit will be to inventory, and the credit will be to account payable. And I'll make up a number here. We'll say 3,000. And a brief description as I will want to see on your exam. Inventory purchased on account. So you should already be familiar with this sort of journal entry, where business purchases goods to resell to customers at a higher price. However, we should go into detail about how the inventory purchase process actually happens, focusing on key documents. One, purchase order. The bookstore fills out a document which states what it wishes to purchase from the supplier, as well as the desired quantity. Number two, a purchase invoice. Upon receipt of the purchase order, the supplier packages the goods and ships them to the bookstore. It also sends an invoice, which is the seller's request for payment to the purchaser. An invoice is also called a bill. And finally, number three, the packing slip. A packing slip is included in the same shipment as the goods shipment. When the bookstore received the shipment, it first checked that everything had been received in good order before paying off the invoice. There are often payment terms negotiated between a seller and a purchaser, which may include sale discounts and return provisions. Sale discount. Lower prices are offered for larger purchases. This is designed to encourage purchasers to buy larger quantities, which boosts sales revenue for the seller. There is no unique journal entry for quantity discount. The lower price is simply reflected on the journal entry to record the sale. Purchase discount is a reward offered for prompt payment. Credit terms are usually expressed as 2% 15, net 30 days, or 2/15, n/30. This would imply that the owed amount is due in 30 days, but the purchaser can pay 2% less if payment is made within the discount period, which is 15 days. So we're going to practice deciphering some more credit terms. This is a pretty straightforward process, so we'll dive right in. 1% 20, net 30. So what that means is the payment, the net amount, is due in 30 days, but you have an opportunity to earn a 1% discount if you pay within 20 days. 2/10, n/20. This means that the payment is due in 20 days, but you can receive a 2% discount if you pay within 10 days. N/30, payment is due in 30 days, but there is no discount available at all. And finally, EOM, which stands for end of the month or end of month. Payment is due at the end of the current month. Let's dive into an example here. Let's assume that the SFU bookstore has been offered credit terms of 2/15, n/30. The bookstore wishes to pay off its May 1st order on May 16th. The journal entry is as follows. So I'm going to stop the video here, and this is going to be a little bit of a tricky exercise because you haven't seen a journal entry like this before, but give it your best shot and we'll cover it at the start of the next video.